So what does this mean for investment portfolios? How do you win market madness, not only this year, but in future years? So this is a basketball court, and you can see this is what the starting lineup of a basketball team looks like. In basketball, teamwork wins games. Every position is important, and it's the same in an investment portfolio. Here's what our lineup looks like. Real estate, private markets, fixed income, equities, and alternatives. The difference with our lineup is everyone starts, everyone plays. Every one of those portfolios has a role to play in our portfolio, and everyone we have an allocation to. Now, John's going to talk a bit about private markets tonight and real estate. We call them the Twin Towers. I'm going to talk a bit about alternative strategies and some of the managers we have in this fund. And if you look at this, this is a book called Big Debt Crises by a gentleman named Ray Dalio. In the book, Ray Dalio talks about 3 iconic debt cases: the U.S. in the Great Recession, the U.S. in the Great Depression, Germany after World War I, the Weimar Republic. He even talks about 48 other cases. So he knows debt. He spent a lot of time looking at debt. Ray Dalio, he's not just an author. He's actually the founder of a company called Bridgewater Associates. He founded this in 1975. It's the largest hedge fund in the world. What they do is they build models to systematically allocate capital based on their timeless view of the world and asset flows. Given how much Ray Dalio has looked at big debt crises, we're confident that he has built models for that, and we want exposure to that given our concerns about debt in the future. According to Barron's, no one was better prepared for the global market crash. We think they're also going to be very, very prepared if we run into debt crises like we could see if we start using modern monetary policy. Now, as successful as Bridgewater has been, they're actually not the best performing hedge fund in the world. That title goes to the subject of this next book, The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. Jim Simons founded a company called Renaissance Technology in 1982. They have about $75 billion under management. He's an interesting guy, Jim Simons. He's a mathematician, and during the Cold War, he worked as a code breaker for the NSA, so he's a smart guy. Renaissance Technology is widely regarded as the most secretive and successful hedge fund of all time. Most people have never even heard of them, but they've made a lot of money, and quite frankly, Jim Simons has made a lot of money. What they do and what they believe is that market inefficiencies are very complex, and they're in a sense hidden in the market code, and they write computer models to identify and profit from these patterns. What we like about Renaissance is that they have an uncorrelated return profile to the market. So we think even if you run into some turbulence and to some issues with what we would worry about in the future with these debt crises, Renaissance will not feel the same impact from those. These 2 funds, both Renaissance and Bridgewater, can be found in our alternative strategies, and we think provide a very good defensive aspect to our portfolio. So the last thing, I've got one last basketball analogy, and it's called the sixth man. So in basketball, someone who comes off the bench and is not a starter but comes off regularly is called the sixth man. So I thought, well, from our investment portfolio perspective, is there a sixth man? And at first I thought maybe cash. That would be perfect. Cash is king. And I thought, well, maybe that would be someone you sub in. And the thing is, though, cash doesn't pay very much. I think you can do better in our bond fund or our gold fund, which I think provides you a little bit more defensive aspects. In fact, the only thing I would venture right now, I'd consider subbing into a portfolio right now would be a good bottle of scotch. But I'm going to keep a glass handy because I think, given what we think might happen in the longer term, you want to maybe have a drink of that scotch. Right now, we think that glass is half full. We think the Federal Reserve and easy monetary policy is going to dominate this year. We think that in that environment, like last year, equities are preferred over bonds. We think returns, though, are not going to be as good as they were last year. And if China stimulates like we think they will, you could actually see global assets outperform U.S. assets. But we also think in this environment, starting to build some defensive aspects in your portfolio makes a lot of sense.